All right. Hey, Vibhu, how are you?
Yeah, I'm good. How are you?
Excellent. Should we get started with how to think about investing?
Yeah.
All right. So, can you tell me the key takeaways? One key takeaway from the first session, which is on the joys of compounding, and one key takeaway from the second session, which is on what gets in our way or what gets in your way.
Right. The first one, like most of like the compounding like effect takes place like later on because at first it starts slowly and then starts to like increase faster and faster because it's exponential.
Mm-hmm.
And as for the second lesson, one key takeaway is I'm thinking, yeah, it was like obstacles in your path, right?
Yeah.
Yeah, wasn't one of the obstacles was like envy, like don't
Yeah.
be envy and jealous, so you get the better view.
Yeah, that's right. I think we spoke about a few things, but if there is one key takeaway, you nailed it, which is to avoid envy. Remember, envy doesn't have any upside, but it has infinite downside.
Right.
Okay, so today what we will talk about is on how to think about investing. So let's get started. First one, I'm going to put this on present mode. I'll switch back and forth. Okay. So you can't build a great building on a weak foundation. So what do I mean by that is, so you do a lot of workout, right? So you exercise a lot, you run a lot, right?
Mm-hmm.
So can you run when your knee is sore, when you have a weak back, and when you don't have a strong core muscle?
You could run, but it won't be like as good as you'd normally be able to, and it would hurt a lot.
Yeah. So what do you do then?
I take it easy.
Yeah, and then you go strengthen, work out those areas to make your knee stronger,
Mm-hmm.
to make your back stronger. And I'm assuming that when you do your track and field, you do have a warm up exercise and you also have a cool down exercise, correct?
Yeah,
Why do you guys do that?
just to warm up the body and just stretch stuff out.
Yep. So basically, it is investing in your making your foundation stronger, so and you can build on top of that foundation. And the same idea applies to investing as well. Before you go and invest your money, you need to make sure that your foundations are strong. Now, what are a couple of things that you should make sure it is set in place properly before you think about investing? Number one, I would say, is to not have debt. Maybe let me explain a little bit. Initially, when I wrote it, I said no credit card debt. Then I said no debt, and I'll talk about it. Now, it's a no brainer that you should not accumulate debt on your credit card. In the sense, pay it off every month, be a transactor and not a revolver. You know what I mean by a revolver, right?
Yeah, revolver is like the people who like pay like the minimum fee and the interest accumulates and they pay more and more.
Exactly, exactly. Now it is very hard to pay 15, 16% interest to your bank and live a comfortable life. The reason is you're making your bank richer by paying them 15, 16, or 17%. So I would say, whatever be the cost, do not accumulate debt on your credit card. In the sense, don't be a revolver. Pay it off at the end of each billing cycle so that you don't incur any interest. Now, other than credit card debt, the next biggest debt that people have, in fact, that's the biggest debt, is student loan debt. Do you know how many Americans have student loan debt? Just make a guess.
75%.
Well, no, just give me in terms of millions.
Oh, millions. How many Americans are right? I don't know, say I don't know, 150, 200 million.
Wow. So
I
that's
mean, I,
that.
I assume a lot of people would take college debt, so
Yeah, they do. It's 45 million, but still
oh,
it's a lot.
45, all
Yeah,
right.
yeah, 45 million. And you know how much they owe together?
Is it in the billions or trillions?
Trillions. 1.7 trillion is what they owe collectively. So on average, it works out to roughly say $38,000 per person. Okay. Now, The student loan debt is something that one cannot avoid, because if they have to graduate, if they need a degree, they have to pay for it. And not everybody are privileged to have money to pay for it from their pocket. So it's something, it's a little to a lot difficult to avoid. If you get lucky, in your case you're lucky to not take a student loan debt, so just use it to your advantage. So student loan debt is something, if you have to take it, well, you have to. There's no other way out compared to a credit card debt, because you need a degree. Well, one can talk about or argue about that, right? Should you need a degree, or you can pick up experience using internet? I think one can, but in general, on average, people need to go to college. So that's the student loan debt. As much as possible, avoid it if you can. In your case, you're lucky. The third debt is mortgage. And pretty much, if I ask the same question, how many millions of Americans have a mortgage? I don't know the number. It should be, the number that you said, maybe 100 million, if not more. Uh, so that's something that I have not taken a mortgage. But that's something that I would completely leave it to you to figure it out. My rule of thumb is simple. If you can afford a mortgage, if owning a home is going to make you happy, then go for it. As long as you can afford the mortgage and you can sleep peacefully. I mean, you should comfortably sleep peacefully at night. If you can do that, then I said, yeah, go for it. If not, think about it twice or thrice before getting into mortgage or before getting into any kind of debt. So to me, when I wrote it as no debt, definitely no, no, no to credit card debt. That is, don't be a revolver. Student loan debt, a person in their 18 years old, they don't have control over it. In your case, you don't have that, or you don't have that challenge. So you're lucky, use it to your advantage. In terms of having a mortgage, I'm going to leave it to you. You're the best person to decide as you grow up and as you start earning. You figure it out. Any questions?
None so far.
Okay. All right. The second important thing, remember, we are talking about building a strong foundation, is to set up an emergency fund. What do I mean by setting up an emergency fund? Life is unpredictable, anything can happen. Mostly people live paycheck to paycheck. If a paycheck stops coming for whatever reason, right? I mean, they might meet with an accident. Maybe they would have to take a break from their work for 3 months or 6 months, if not a little longer. What do you do if paycheck is not coming in? So you need to have an emergency fund. A fund, it could be savings that can cover your 3 months of expenses, or it could cover 6 months of your expenses, or it could cover longer. You decide how much of an emergency fund that you want to build so that you feel comfortable. It's more about comfort, because uncertainties happen in life. All right. So read this excellent quote from Warren Buffett.
Mm-hmm.
Okay, cash is like oxygen. When you have it in abundant, you don't realize it, or you don't realize the importance of it. When it stops coming, that's when we feel like, man, this, I can't live without it. So cash is like oxygen. So we need to survive. Have an emergency fund so that it can take care of you. Cool. Remember, even oxygen was hard to come by, all in New York as well as in India. Remember what happened in New York,
Oh yeah, the
in
pollution levels.
not the pollution level. I mean, the whole COVID situation that happened, where
Oh yeah, and that yeah.
yeah, and then India went through the same situation very recently in the month of April and May. Even oxygen was very hard to come by. It's only when we don't have it we notice it. Cash is very similar. So create an emergency fund to cover for any kind of emergency situations. So this is a letter that was written in 1939 to a guy by a guy named Ernst. He wrote it to his youngest son, and his youngest son's name is Fred. So Fred is the uncle of Warren Buffett. And what Ernst did was, Ernst was saving money, little money, maybe every day, every week, until that pot reached $1,000. So what Ernst did was, he wrote this letter and gave this letter along with an envelope containing $1,000 and gave it to his son, who is Warren Buffett's uncle. And the reason, and then read this line, it is my wish that you place this envelope in your safety deposit box and keep it for the purpose that it was created for. Should the time come when you need part, I would suggest that you use as little as possible and replace it as soon as possible. The
What
reason
does it
why
mean by replace it as soon as possible?
that is, so let's take you are in an emergency situation. Let's take you use half of this, right? Say 1,000 becomes 500. Now you
Oh,
the emergency goes away. Now refill that 500 back to 1,000.
oh, that's what it means by replace. All right.
Exactly, exactly. Now I'll tell a real, an incident, right, that happened in our family several years back or a few decades back. So maybe in the early 90s, my father or your grandfather suffered brain hemorrhage, right? A vessel in his brain popped, and he could not continue with his. He took a long medical leave, and just 6 months back, my mom or your grandmother, she passed away. So the situation was within a span of, or a short span of 6 months, there was no one going for a job, or there was no paycheck coming in on a consistent basis. And the biggest advantage my father or your grandfather had was, we had to pay no rent because it was our own home, and it was paid off, in the sense we did not have any mortgage. So no rent to pay, which is a huge advantage, one, which is no debt. The second huge advantage we had surplus, which is stored in form of gold. So we sold that gold and put that cash into, think about it like a bank. It's not an actual bank. It's called as benefit fund back then. They were paying interest rate of 22%, which is unbelievable. I'm talking about 1992,
Oh,
1993.
what do you mean? Like they give you money?
Yeah, no, you put $100, they give you $22 every year.
Oh, so what did they get back?
Yeah, that's a good question. So they use that $100 and then they lend it out for, say, 30%, right? So they'll get
Yeah.
$30 from someone. They'll use some of that 30 to run their business. Let's take they use
Mm-hmm.
$2. So they still have 20 to $28. They give me,
Yeah.
because we put money in there, $22. So they might still have $5 or $6 surplus. That's their profit.
Yeah. But isn't that what a bank does? Like like a bank uses the money you give them to like invest in other things. So
Yes.
why does like a bank like not have to charge as much of an interest? Like a bank doesn't give you much money back. Well, the company you said is like 22%, right?
Yeah. So back in those days, India did not have private banks.
Oh.
1992, all banks were public banks, and usually they don't lend for, they need collateral, in the sense you need to give them land, you need to give them land documents, or you need to give them some immovable property. Not everybody would give, even banks lent money on gold, but their percentages will be low, because remember, right, it's a government or it's a public entity that is owned. So there was a lot of demand for money. So let's say I need money, and I might not have a collateral to lend. Maybe I could start a business. So banks don't lend for you to start businesses. So what they call as venture capital here in the Silicon Valley, or maybe in the US, and it's very common in everywhere throughout the world, they did not exist back in India. So you go to places like mutual fund that I said, so they would be taking risk. They would lend it to you, and in exchange you might give them gold, or you might give them something. So banks were not doing those kinds of deals.
All
Does it
right.
make sense?
Yeah. Yeah.
So yeah, the long story short here is, no debt, which helped us back in the 90s, and that emergency fund that we had, we used it to generate cash, and we were spending on that, in the sense our family was running from the interest that was coming in from that cash that we had stored in the form of gold. Cool.
Mm-hmm.
All right, so once the core foundation is taken care, now whatever surplus we have, we need to invest. Now before we talk about it, why even invest? Why not keep the excess cash under the mattress. When I say under the mattress, I literally mean under the mattress,
Oh
or
yeah.
I could, put it in my bank account.
Okay, yeah, I mean, I think I know the answer for this is because like money, due to inflation, the value of money increases by like I don't know about 2%. But like if you just store it like under your bed or something, it the value of that money will slowly decrease and decrease, right?
Yep. Yep. So let's look at that. I think you hit upon an interesting point, which is inflation. So when I came into the, when I came into the US, which year?
Oh five.
Yeah, 2005. So I went to Starbucks. My friend took me to Starbucks for the first time, and he got me a cup of mocha, cafe mocha, a tall
Mm-hmm.
mocha.
Yeah.
It costed $1.85. I don't remember it exactly, but it should be around that range, $1.85. Today, do you know how much the same mocha costs?
I mean, it says 2.4 times
Yeah.
that price. So
Yeah, so it's like 4.4, I mean $4.45, or say $4.50. So the price of mocha went up by, as I said, right, 2.4x. Or if you want to know how much the inflation is, it's 5.6%. Okay, one example. So what happened is the money's purchasing power got reduced. So whatever $1.85 was buying, which is a cup of mocha, I can't get the same cup of mocha for $1.85. I need to put more. In fact, I need to put 2.4x more to get the same cup of mocha. Next
right.
example. So back in 2005, do you know how much we paid for a one-bedroom apartment?
No, was it under $1,000?
Yeah, it was $975. Do you know how much the same one bedroom apartment should roughly cost? I have not checked, but I can ballparkishly say what it
Is
should
it
cost.
above 2,000?
That's more. It should at least be 2,700, if not a little more or a lot more.
Close to 3,000.
Yeah. So, the inflation rate, or it went up close to 3x. Close to 6.6% is the rate of inflation. So, but not everything went up in price. Can you think of an example where the price went down?
2008, right? The house market crash.
Yeah, but did it still, is it low or did it recover?
It recovered.
Okay, then maybe that might not qualify. Think of an example where the price was higher in 2007 or 8 compared to now.
Oh, are you talking about like COVID where
No.
no? Wait,
Yeah.
repeat the question one more time.
So coffee price went up.
Uh-huh.
Think of an item that, does every item price go up as time passes by, or
Oh no, some like decrease over time, or like maybe technology because
yeah,
oh yeah.
that's where I was coming to. Okay. Now, remember this television?
Yeah.
Yeah,
It
so this is, so I just, grabbed it from Google image search. The example I was trying to quote is in 2008, we bought our first flat screen TV, Samsung, 40 inches. Do you know how much it costed?
um no.
Close to $1,000.
Yeah, and it did not look like that TV on the
Yeah.
slides.
It's not. I think
Yeah, the
this is
sides
the,
are a bit thicker.
yeah, 40 inches, close to $1,000. Today, remember 2019, we bought a new 75 inches TV.
Yeah, it looks similar to this one.
Exactly. So this is, I believe this is that one. 75 inches, more or less we paid the same price, maybe a little higher. But think about it from the capability standpoint. The TV today can connect to the internet. We can watch Netflix, YouTube, Prime, whatnot, just by clicking a few buttons with our remote. And TV is smart. It's a real smart TV. It runs on Android operating system. Compared to this TV back in 2008, is a classic case where price went down but quality went up leaps and bounds. And you will find this similar, as you said, with technology. Take iPhone. For close to say $1,000, you probably will you'll get iPhone 12, and it fits into your pocket. Its power or its computing power is several orders magnitude higher than the computer, even a supercomputer back in the 1970s, which would be costing millions of dollars, and you might need a huge room to store it. Quality went up, price went down, right? So this is an example where not everything goes up in price. What do you call this concept as? When it goes up in price, we said inflation. When it goes down in price, we said, what is it called as?
Deflation.
Yeah, deflation. Now here's a question. If you are a central bank or like
Yeah,
Federal Reserve in the US,
the Fed.
yeah, the Fed, it's the central bank, right? In the US,
Hmm.
they don't use central because it's a free country. Nothing is centralized, right? That's the nature or why they
Yeah.
use the name Federal Reserve, but in reality, it's a central bank, bank of banks. If you are the head of that bank, would you worry about inflation or would you worry about deflation? Which one would you avoid and why?
Deflation, because like the rate of the money is like representative of the country. So if it's deflating, that's bad because it shows that the economy is doing bad.
Hmm.
But at the same time, like too much inflation is also bad. It's like this like fine like line where you need like 2% of inflation or something.
Yeah, so basically, the idea Fed says is, hey, I don't want deflation. Deflation is bad. The reason why deflation is bad is interesting. If you think about it, right? Let's imagine we want to buy a TV. Okay.
Mm-hmm.
Let's take it's deflationary. What is deflationary? Prices will go down.
Yeah.
Would you buy the TV today or would you wait for another month to see what the new prices are?
Um, I mean, if it's cheap right now,
Yeah. Well, you don't know. You know that deflation is happening. Prices are falling
oh yeah,
crazy.
I mean, yeah, you if you wait longer, it could deflate by even more.
Yeah. So you wait.
Hmm.
What happens when
And
you wait?
you don't spend,
You don't spend. So companies can't make money. What do they do when they can't make money?
they got a business.
Yeah, so they lay off people.
Hmm.
Then they would not be having money to spend. So it's like a death spiral, right? It spins, it's a vicious cycle where it can pull down an economy to a grinding halt. So that is something that Fed or any central bank want to avoid. No deflation, please. That's that. Okay. Now let's look at why does inflation be there? What do you think could be the reasons?
Oh, what could be the reason of inflation?
Hmm.
Um, I mean, inflation represents like the economy, right? In a way, like how
Yeah.
good. So maybe when the companies and the government is making more money, uh the value of the money goes up. I don't.
Yeah. Yeah, kind of. Yeah, you're going along in the right direction. So think about it, right? Feds, one of the primary mandate for Fed or it's their responsibility to make sure everybody is employed. When I say everybody, they define it as mostly, but let's for this discussion, let's take they want to keep everybody employed, right? For
Hmm.
everybody to be employed, every company or most companies should be able to sell a lot, right? I mean, they should be selling more. That's when they can employ more people, right?
Yeah.
Which means for them to sell, there needs to be demand, right?
Hmm.
So when there is demand, so what happens is, right? So companies want to sell a lot more. So you kind of create a demand in the sense you make people go out and spend a lot more so that the companies can hire a lot more, and they would be able to pay to people who are nothing but employees who in turn go out and spend more. This is a virtuous cycle that is happening, and that's what Fed is trying to do. The way in which they are trying to do is, let's and then credit is another mechanism. So do you spend more when it is easy to borrow, or would you spend more? Sorry, maybe let me rephrase it. If you have a lot of money, would you spend more, or would you spend more if you have less money?
I mean, you'd spend more if you have more money.
Yeah, so would credit put more money in your pocket? When I say credit, it's like, hey, I'm lending you money to go spend, like buying a home. When you buy a home, you buy.
I mean, Yeah, because technically, like, I mean, I know people shouldn't do this with a credit card, but it's like you could technically spend however much money you want with a credit card because it's just like the company just like loaning you money.
Yeah, yeah. So what happens when everybody spends more? Everybody wants all the items. What happens?
The companies do better, the government does better, economy is good.
Yeah, but there are not that many items, right? I mean, remember demand and supply. When there's more demand than supply of a particular item, take a TV. Everybody
Mhm.
wants to buy. Then
There's a
what happens?
shortage.
Is a shortage. So what happens to the price of that item?
It goes up.
Yes, and that up is what inflation is all about, right?
Mm.
So you create demand, you extend credit, and that creates companies to hire a lot of people. Now company make money, now they want to keep their employees happy. What should they do for keeping employees happy and motivated?
I don't know, gives them good benefits, a good salary.
Yeah, and also give them increment every year.
Oh yeah, increase their salaries, right?
So see, everything is going up, and along with that prices also go up,
Hmm.
right? And there's one other advantage which governments and everybody that borrows have. When there is inflation, let's take I have to pay bank $100. Let's take I borrowed that money in 2020. Now I need to pay that money back in 2030. Now with inflation, that $100 will be worth less. Correct?
Oh yeah.
So I can repay it easily with future dollars in the future. And
Mhm.
governments across the world, they have debt, and it is much easier. So that's why government, or if you are a Federal Reserve or a central bank, you should favor inflation over deflation. And not only that, again, you don't want too higher of an inflation. You just need a moderate level of inflation.
Right.
Any questions on this?
I mean, I don't know, just a curiosity. Like, when you pay a loan, you have to
Yeah.
pay like a certain amount of money back in debt, but that's like that's over time, and over time the money would like inflate, right? In like good scenarios. So
Mm-hmm.
technically, like I don't know, didn't the example you say is like the countries do this like they take a loan, so the amount of money they have to pay back is like worth less and less over time. So
That's correct.
so I mean like so I mean doesn't that kind of like show that loans can sometimes be good? Like if
Yes.
you
Yes. Yes. Yeah. Yeah. Continue your question. Sorry.
so yeah, like maybe if you're taking a loan that's over a longer time period, maybe like a mortgage or I don't know, maybe a car loan or a student loan, wouldn't that be like a good idea if you need it?
Yes, so that's what I said.
Yeah.
Not all loans are bad, and
Hmm.
you use your judgment as long as you can pay your mortgage. Say, for example, you take a bet, oh, in 30 years inflation will be higher, which appears to be the case. But what if you had to pay a mortgage of say $8,000, but your income is per month, and your income is $11,000 per month? Okay. Now let's
Hmm.
take you can run your family in $3,000, which is highly impossible, but let's pretend for now that it is there. Now, what happens when something bad happens? Say you're out of job for 6 months for whatever reason, then what happens? So those are some things that you need to think through. I'm not saying bad things will happen. Mortgages, they are not bad as long as you can afford those loans. But your point, you're spot on with that particular point. Not all debt is bad.
Right.
All right, moving along. Inflation again. Why to invest? Because inflation eats into our savings. So what I did, and that there's a reason why I chose 2003 as a starting year. Do you know why 2003?
Um, I mean, was there something special that happened in 2003?
That,
Oh, is it okay? Yeah, that's when I was born.
yeah, exactly. That's the
All right.
reason,
I
right?
just wonder if there's like some world event.
No.
Okay, okay, just
Yeah,
all
just
right,
to
just
give you an idea. So
all right.
CPI stands for Consumer Price Index. It's like a loaded word, but the idea is very simple. So what they do is they price a basket of goods. Just for argument's sake, let's take in a bag I have a laptop, and let's take an iPhone. I'm just making up an example. Let's take back in 2000 and say 12. Let's take if this basket costed $100. Okay.
Mm-hmm.
Now the index is 100. You just divide 100 by 100 in 2012 and you say you set the index to 100. Now let's take in 2020, this basket of iPhone and a laptop went up to $150. So in the
Mm-hmm.
numerator, you would put 150. In the denominator, you would put the base year. In this case, it's 2012. You would put 100. So the index will be 1.5, right?
Right.
So sorry, 150. So the base, so that's how this is computed. You create a basket of goods, compute the price for a base year. Base year can be anything that you want, and you can compare that with any year forward. Let's take the example over here. I don't know what the base year was, but in 2003 it started at around 183, a little over 180. It went all the way up to 267 or close to 270. So the inflation during the period since you are born till today is 2% roughly. Actually 2.12 to be precise. Make sense?
Yeah.
Yeah, so now, okay, another thing, right? Let's play around with this calculator. I found it very interesting. So 2003 June, I put $100. That $100 back in 2003 has the same buying power as $142 in Jan of 2021. Is this
Mm-hmm.
clear to you?
Yeah.
That is the reason why we need to invest. Imagine you put this $100 under your mattress, and then all
Mm-hmm.
of a sudden you take it on Jan 2021. For you to buy the same item that you could have bought in 2003, $100 is not enough. You need $142.
Right.
Okay. Now let's go back to that calendar. This is a very interesting. I thought this is a cool calendar. Okay, let's look at this. Remember, I said the letter was written in 1939. I don't know which year in 1939. Ernst wrote to his youngest son, Fred,
Mm-hmm.
right? So let's take how much that thousand is worth today. You see?
Yeah, almost 20,000.
Yeah, almost 20,000, roughly, depending on what that nature of, yeah, how much each of us would spend a month, that many months of expenses would be covered. So you should play around with this tool, and you can also go back in time. Let's take, you can put 2021 at the top and then see how much this would have been, means say 1940 or 1950. Make sense?
Mm-hmm.
All right, moving along. So this is a reason where the point that I wanted to convey is you cannot just keep money under your mattress. You need to invest because money's purchasing power is lost over a period of time. And that's the policy that every government wants to have, because if they want to have maximum employment, they need to inject some amount of inflation in the system so that everybody can run behind something and the whole machinery can run. With that, now what to invest in? Correct, because there are millions of things that
Mm-hmm.
we can go and invest in. So what I did was ask myself this question: what assets or where do American households or US households have invested their money in? Okay,
Mm-hmm.
now as of 2021, 40, close to 45 trillion has been invested in non-financial assets, and 110 trillion is invested in financial assets. So put together, it will come to 155 trillion. You know how much is 155 trillion?
A lot.
Yeah, and always, right, when you think of big numbers, always compare it with something. In this case, America produces 21 trillion every year, which is the GDP of the country.
Mm-hmm.
And this is 155, which is roughly 7 times of the GDP. Again, remember, this is a stock. This is what Americans have accumulated over the years. GDP is a flow concept, which is what they earn every year. But just to give you a rough way to comprehend or get a hang of this number, 155 trillion is the overall assets owned by US households, and every year US produces say $21 trillion of GDP. Okay.
Mm-hmm.
Now what do I mean by non-financial assets?
I mean, things that are don't increase in value, maybe, but like not stocks or bonds,
Yeah.
or yeah.
Yeah, non-financial is like not stocks, not bonds, not cash, not yeah. So those are non-financial. The best example of non-financial is real estate,
Mm,
right? Real
yeah.
estate is a non-financial asset. Your car is a non-financial asset. All the appliances that we have in our home that we own is a non-financial asset. Everything else is bucketed under financial asset. Okay. Now, always remember, we need to break down what goes into this bucket to get a good understanding of it. So the best part about it is the central bank publishes this data, and you can go back in time to look at how the composition have changed and what that number is. So what I have done is I've broken it down this way. Can you see the sheet?
Hmm.
So non-financial is 27%. Financial is 73%. Okay.
Yeah.
And when you look at all numbers, a lot of numbers, focus on the big things. What is the biggest bucket in the non-financial assets?
Real estate,
What percentage of it? American,
23.
23. And consumer durables are like your cars, your refrigerators, washing machines, etc. So let's not worry too much about it. It's a small number, 4%. Now, within financial assets, what's the big thing?
Corporate equities and mutual fund shares.
Yeah, which is basically stocks and bonds.
Yeah.
What is pension entitlements?
I don't know, benefits from pensions and all, like maybe.
Yeah, it's a good guess. So you're right. So remember, right, in the US, some time back or long back, companies used to pay pension.
Mhm.
Governments, they do pension in the sense after you retire, you'll be getting some money every month. And even some car companies and a lot of steel companies, they used to pay pension, but they don't pay anymore. Instead, what they have is called as 401k.
Oh yeah.
Something called as defined benefit plans and defined contribution plans, all loaded terms. Defined benefit is your pension, where you get something every month after retirement.
Hmm.
But what companies have done is instead of they paying you pension after retirement, government came up with a plan like, hey, look, I'm not going to tax you X dollars. That should be around 19,000 as of now for a person, for a working person, where you can invest that money in stocks and bonds, or it could be you can keep it in cash. Use that to compound so that you have enough nest egg built when you retire. And that's what 401k is all about. Your 401k, IRA, they're all pension entitlements. So how much is in that? 21%. But roughly they'll also be in stocks and bonds. And then what is equity in non-corporate business?
Um, is that what a bond is? Maybe.
It's a
No.
stock. It's a
Oh.
stock. Except it's not a corporation. Like it's not like your Apples of the world or Amazons of the world or Googles of the world. Instead, it could be all the small businesses that are not big corporations. Think about it that way. All
Oh.
your, yeah, it's like, you start your own business. You have an ownership in that. It could be you would own it 100% or you would own it 50%. Let's take you partner with somebody. So that's the equity in non-corporate business. That's roughly 9%, right?
You're
So if
right.
you add it all up, what percentage does it come to over here? 55%.
Mm-hmm.
So you can say, right, in America, households own a lot in equities and bonds, right? A lot more in equities is what I would say. And then the next biggest bucket that they are owning is 23% on real estate. So put together, they add up to what, close to 80%,
Yeah.
right? Two buckets, two big buckets. Rest of it, I'll come to it, but two big buckets. So in America, households own a lot of equity. When I
Mm-hmm.
say equity, it's stocks and bonds, and I'll talk
Yeah.
about them separately. And then real estate. These are the two big buckets. Now, here's a question. Do you think Indians have a similar composition, or would their composition be different?
Um, I think it would be similar.
All right, let's look at it. You answer if it is similar.
Uh, from what I can see, no, because it's a higher proportion in properties and gold, and
Yeah,
equities is pretty low.
exactly. So every country is different. And do you know why Indians have lower penetration in equities?
Equities is like stocks and all, right?
Yeah, that's right.
Um, I mean, I don't know much about the Indian economy, so no.
Yeah. So the reason is India, remember, it was all a lot of it, lot of businesses were owned by government. Remember, I told you banks were run by government. Even today, it is there. But India liberalized, opened up its markets in 1991, and a lot more private businesses started coming out, and they can grow without any limitations. Until then, they can only be of certain size, they can only employ so many people. There were a lot of restrictions, and that's why equity percentage was hardly there. Say for example, my dad or your granddad, most of his net worth was in real estate slash gold and some bank deposits, 0% in equities. So the point I'm trying to convey is every country is different, and you should understand that before asking yourself like, hey, where are people investing, why are they investing, where are they investing, so that you would have a good idea. Make sense?
Yeah.
All right. Now, by the way, I got this chart from my friend. His name is Kuntal Shah. Just
Hmm.
wanted to give him credit for his work. Cool. All right. Now, what I did, I took this bunch of things, I simplified it further so that we can talk about them and understand a few things. Okay. You know
Yeah.
what a checking account is, right?
Uh-huh.
Yeah. So it's like the money that you keep in bank. You
Hmm.
know how much interest rate we get in checking account?
None.
That's what I said. Return is zero.
Yeah.
Is checking account safe?
Yeah.
Very safe.
Yeah,
What's
because
the
you're
Yeah,
yeah,
go ahead.
you're not gonna lose anything. So
Yeah, it's FDIC insured in the sense up to I think 250K.
hmm.
You're going to be guaranteed that money. So there's safety is very high. You know what the duration is in the sense, is there any lock-in where you would have to keep money for a long time? There's nothing of that sort in checking.
No.
Is it volatile? What do I mean by volatile is you
Uh
yeah.
I mean a lot of fluctuation, right?
Yeah.
Yeah, no.
No, that's what I said. So what I'm trying to do, Vibhu, here is I'm just looking at three independent variables: safety, duration, volatility,
Hmm.
and then I'm looking at return as a dependent variable.
Yeah.
I'm going to explain you a few fundamental concepts in terms of how to think about assets. That's what I'm trying to do here. Okay. Let's get to money market. So let's take that you have a lot of money in checking account. You don't need all of them, and you're not getting paid anything. You're saying like, hey, why don't I park some of it into something, and I need my money 1 month from now or 2 months from now. At least let them pay me something. That instrument is called as money market fund. It's relatively safe, where they invest in government securities, and most of it will be in government securities. Uh, you know what the return there is?
It says over
0.1%.
there, yeah,
Yeah,
0.1%.
it's hardly anything, but it's better than zero.
Hmm.
If I believe so,
Yeah.
up to a year, you can hold it for a day too, because there is a market where you can go and sell anytime. So that you can pretty much sell it whenever you want to sell it. But usually it comes with a duration. Whatever assets you hold, it could be 3 months. Hold duration will be there, or 6 months duration will be there, or 1 year duration will be there. Is it volatile? I don't think so. It is that volatile. Maybe not like a checking account, I would say, but I would still categorize it as no. Okay. Now let's take this, the third category, which is certificate of deposit. Now you can go to a bank and say like, hey, I want to move some of my money in my checking account into CDs, where
Hmm.
I don't need this money for 1 year. You use it, but pay me interest. Okay. Now how much
Yeah.
do you get on average?
0.5%.
Is it safe? I believe so.
Hmm.
It can vary. You can have a 3 month to 6 months CD or a certificate of deposit, and it can go up to 2 years. Is it volatile? No, it's not
No.
volatile, right? So what you see here, the first relationship, right, with three examples. When the
Hmm.
volatility is low, where are you? What is your return?
It's pretty low, less than a percent
When
or
the
less than
safe,
0.5. Yeah,
yeah, when the safety is high, what's the return?
it's low,
When the duration of a lock-in increases, I mean, if the duration is short, what's the return?
low.
Low, right? I mean, just try to, I mean, again, I'll show it in chart. Continuing along, now let's talk about bonds. Government, it could be central government, or the federal government, or a state government like California state or state of Texas, or a company. they borrow money. They need money to run businesses, so they would borrow. For them to borrow money, they issue something called as a bond. All the bond says is, you pay me X dollars, or say $1,000 in principal, and I'm going to return you that money in 1 year, 3 months, 6 months, 10 years, 20 years, whatever the duration. It's called as the duration of the bond. And I'm going to pay you X% interest every year. And that interest payment can happen on a quarterly basis, or it cannot happen on a half yearly basis. Usually, federal government pays it on a half yearly basis. Okay.
Mm-hmm.
So here's the kicker. What happens when a business goes bankrupt? Let's take you lent money to, let's take which one? Uh, Borders. Okay.
Yeah.
Basically, you bought Borders bond. Is Borders in business today?
No,
And what would happen to your bond money?
it'd be gone.
Well, it depends. It depends on the type of bond. So a company, if I have to simplify it, a company needs fund to start its business and run its business, right?
Mm-hmm.
When I say funds, money.
Yeah.
One kind of money is equity, where I am going to start a business, where I'm going to put my own money and I'm going to raise money from my friends, families, and I might issue shares and I might raise money from the public.
Mm-hmm.
The other way to raise money is by borrowing. The difference between the two, the through equities and through borrowing, is this. When a company does really, really well, take Amazon,
Mm-hmm.
you will make a lot of money as a shareholder, because you can claim a share in their profits. That's what a shareholder is. You claim a share, either a profit or a loss, you can claim a share. Whereas a bondholder is going to get paid that particular interest. That's it. Whether a company makes a lot more profit doesn't matter. It's like paying a rent. Let's take we are a tenant in a house. I'm going to pay X dollars in rent. Whatever my income is, I'm not going to pay more depending on my income. A bond is like that, where I'm
Mm-hmm.
going to get paid some interest every year, and that's about it. The game is done. So that's why when a company loses or goes bankrupt, shareholders get hit first badly. The reason is, remember, they are going to enjoy on the upside, which means they should also take the
So,
beating on the downside.
right.
Whereas a bondholder, a company will get liquidated. When borders got shut down, they would have sold all their assets. Whatever is remaining, it will be paid to the bondholders first before they are going to even come to shareholders. Does it make sense?
Yeah.
But that's why I said, if you look at the returns, so what I've done is I've looked at a basket of bonds. It's the Vanguard Bond Index, and I've looked at their 10-year return. It's roughly 3.3%. Safety, I've said no. And average duration I've taken is 8 to 9. And volatility is medium, because bond prices can move up and down, and I'll explain you why. So the volatility is medium. Okay.
Mm-hmm.
Now, real estate, it should be very clear to you.
Yeah.
Either you go buy real estate or you go buy a company that deals in real estate. So they are very long duration. Usually, real estate is not something that you do for a day or two or three. High volatility, safety is no. Remember what happened in 2008 crash? So many real estate, pretty much across the US, they corrected by 30+%, if not more. A lot of people lost their homes. A lot of real estate company also went under. So that's why I said safety is no. Finally, stocks, extremely volatile, long duration, no safety, and in the last 10 years, it returned 14%. Okay.
Right.
Now, here's a question to you. I said duration is long for a stock,
Mm-hmm.
but you can sell an Apple stock or buy an Apple stock in a split second. Why am I saying duration is long when I can buy and sell instantaneously?
I mean, it takes time for the stock to return the 14%, right? It's not going to do it in one day.
Exactly. I think, see, end of the day, right? Underneath, it's a business that is being run. When I say a share, I'm not talking about trading in and out. I'm talking about holding that business or a collection of businesses for a very long time. Now,
Mm-hmm.
stock market like your NASDAQ or your NYSC, they are there. They create liquidity in the sense they pull in millions of buyers and sellers into their marketplace, and that gives you enormous power in terms of liquidity. I can sell it anytime and get my cash back. I can buy it anytime if I have cash to invest in. But because people trade in and out, it is extremely volatile. Extremely volatile. That's where volatility comes in. Now, can you summarize three principles based on the independent variables? High safety, would it give you high return or low return?
Low return.
What about duration?
Higher the duration, higher the return.
What about volatility?
Higher the volatility, higher the return.
Makes sense. Yeah. But again, this is all else being equal. You can come up with many counter examples to say that is not the case, but I'm just talking about on average, all else being equal. So this is the relationship. Your independent variable is an x-axis, and dependent in all three cases is return. And can you tell me why this is a downward slope?
Because yeah, it's what we talked about earlier. The more safe something else, the less money you'll get.
Totally. Makes sense. Is this clear?
Yeah.
Cool. So this is clear. This is clear. Okay. Now, so this is the return variation with asset classes from 1985 to October 31st, 2020. Focus on cash bracket T-bills. Don't worry too much about T-bills. Just think about it as cash slash money market slash everything. What can you
Mm-hmm.
say about that?
Um, I mean, wait. So what does this represent? The variation, just like how much the value changes?
Yes, the minimum,
Oh,
maximum, and then
oh yeah,
average.
yeah, yeah, yeah. I mean, yeah, I know box plots. Yes, since there's like it's very narrow. There's not much variation, so the value doesn't change much.
Does it align with the example that we looked at?
Yeah.
Makes sense. Okay, now let's jump to bonds. What do you think of bonds? All US bonds.
Um, I mean, we can see that it's much wider than the cash, so it's going to be there's like more variation, but not like too much compared to the things above it. So it's still
Got
pretty
it.
like safe,
Got it.
but not
Makes
too
sense.
safe.
All right, let's look at US large cap stocks. What do you think about it?
There's a lot more variation
Yeah,
where
minus
like
20.
the lower, I mean, if you look at like the average like increase, it's
Uh-huh.
going higher and higher from like 0.7% to
Yeah.
4.1% to
Mm-hmm.
9.6.
Mm-hmm.
But at the same time, there's also that good chance where you could get to a uh negative like variation.
Yeah, and that volatility exists because of the market. People jump in and out, and there's always, this crazy reactions going on. And look at the top one, emerging markets. These are your Indias of the world, right? Look at how
Yeah.
much they are swinging,
Mm-hmm.
right? So this aligns with this, right? Or do you
Yeah.
see any contradiction?
Uh, Not from like eyeballing it, no.
Yeah, and then even REITs pretty much showed the same behavior.
Yeah.
Yeah, REIT is like a real estate investment trust. The idea is simple. You just bucket a bunch of real estate, commercial, residential, and you these companies deal with many real estate, and then you can buy and sell them. That's what a REIT is. It's like, think about it like a stock, but these
Mm-hmm.
company predominantly they deal with real estate. That's why they are in this bucket. Okay.
Right.
Now, let's talk about an hypothetical example, which I'm going to explain the relationship between asset price and interest rate. Do you know what the symbols here mean, or the images represent?
I mean, do you have to ask me?
Yeah, tell me. I don't know.
Yeah. All right. Yeah, they're the video game like console companies.
Yeah, tell me which one is which.
That's PlayStation.
Yeah, the leftmost middle one is.
That's the Nintendo Switch, and that's the Xbox,
Yeah, do you have all
Microsoft.
of them?
Yeah.
Yeah, that's good. Okay. All right. Now let's go to, we looked at the sheet, we looked at the sheet, we looked at it. Okay, let's go to the gaming example. So this is an hypothetical example. So let's imagine there is a company called a Safe Company. I just made it up.
Mm-hmm.
Okay. They are going to charge you $100. Let's pretend that it's a year one time $100 they are
A
going to
hun-
charge.
$100 for the console or the game?
No. Yeah, I'll explain. So you're going to
All
pay
right.
them $100. They will give you the console, and they will give you all three consoles. You can pick and choose what you want. They
Mm-hmm.
will give you 10 games in 1 year to play. You pick and choose whatever 10 games they have.
Yeah.
And I'm just putting $1 per game, hypothetical example. So
Oh
which
wow.
means in 1 year, you are playing games worth of $110.
Mm-hmm.
Okay. Now, what is the interest rate that it works out to you? Or maybe for company safe, it's 10%.
Yeah.
Why? Because I'm saying you are getting $10 worth of something, or the company is paying you $10 worth of something for you putting in $100, right? You put 10 in the numerator, 100 in the denominator, you get $10, 10%.
Oh yeah. Okay.
Now, let's take, this company is doing really, really well. This company has a terrific brand name. Everybody knows it. In the same place, another company comes up. It's called as a maybe safe company because they are just starting their business. Now,
Mm-hmm.
if they charge the same $100, people
Yeah.
might not buy from them. Think about it for a minute.
Um. All right. Yeah. All
Because
right.
yeah, they might, like, I'm putting in, $100. What if they go out of business? So in order to entice customers, let's say that they are going to charge less, and I'm saying they are charging 90%. Okay.
Mm-hmm.
Now that alone is not enough. They are saying, look, Vibo, that safe company is only allowing you 10 games. I'm going to pay you 12, allow you to play 12 games.
Yeah.
Price of the game is still one.
Mm-hmm.
Now, how much worth of games you are playing in a year?
12.
What's the interest you are getting or the other company is paying?
13%.
Right? Is it higher?
Yeah, you're getting more.
More, right? Now, there's one more company that comes up. It's unsafe, where that founder has some shady history, and people are aware about it. So, which means he can't even charge 90.
Mm-hmm.
He's charging a little less. Let's take, 70% of the first guy.
Yeah.
And he says, look, Vibo, safe is 12 games, sorry, 10 games, maybe safe is 12. I'm going to allow you to play 15.
Yeah.
Price per game is one. So that's 15, and that's 21%,
Mm-hmm.
right?
Yeah.
Now, let's take, what do you, is the first lesson, what's your key takeaway from this before we continue further?
Well, I mean, I don't know. The ones that are more unsafe is more of a gamble, but you get more like interest back.
Yeah. So yeah, they would be, I mean, they have to lower their price according to the price set by the safest person. Correct?
Yeah.
Now let's take look at what happens. Safe comes back and increases the price. Price goes up. Let's focus on safe alone.
Mm-hmm.
What happens to the interest rate when price went up for safe?
It went down, right?
Yeah. Why?
Because well, I mean, you're putting in $200, but you're still only getting $10 back.
Exactly. Right. So when the
Yeah,
price goes up, what happens to the rate or interest rate?
it goes down.
What happens if price goes down?
Interest rate would probably go up.
Yeah. So price and interest rate are inversely proportional. Right.
Mm-hmm.
You see that?
Yeah.
And not only that, all other guys, they have to dance to the tunes of the safe guy.
Right.
What happens? Let's take safe raises the price to, sorry, decreases the price to 50, and unsafe keeps it at the same price. Would you go and buy from unsafe, or would you go and buy from safe?
Um, I mean, you're still getting like a greater interest from maybe safe,
No,
right?
yeah. No, in this example, because I've just lowballed it, right? It's automatically taking 0.9. But let's take, I'm just doing this as 90, hard coded 90, but I say I just change this to 50. Now, what happens to the interest rate of this guy is 20, this guy is 30,
Yeah.
right?
Oh, yeah. Then you'd go for the safe.
Yeah. So the key takeaway from this, so what I did, Vivo, is I charted something so that you would understand probably one of the most important concept in finance and investing. which is the relationship between price and interest, and
Mm-hmm.
the relationship between a safe company. The reason I'm saying safe, you'll understand why. Maybe safe is this one: when there's an inverse relationship, it's a downward slope. As price goes up, rate comes down, and as price comes down, rate goes up, right? That's why the
Right.
line is bending down, or it's going down. And look at safe. Whatever safe is charging, everybody else needs to dance to their tunes. Over here, safe is charging 17% interest rate,
Mm-hmm.
but sorry, safe is paying 17%. The maybe safe guy has to pay more, and the unsafe guy has to pay even more. So two relationships you can see. One is the relationship between price and interest. They are inversely proportional. And the second important lesson is the safest asset is going to set the tunes of the market. They control the interest rate for all other asset. Now, what is the safe equivalent in the US financial industry that you can think of?
The saving. Oh, like a stock.
Yeah,
I mean, right now maybe like a big tech company. Like
sure. But that can also go out of business. Who cannot go out of business?
who cannot go out of business. Uh.
Safe is like that. That's what
Oh
I
yeah.
just created this hypothetical example.
I mean, does it have to be like a corporation
No, it
or?
need not be. It can be
I
your.
mean, could the government go out
Yeah,
of
yeah, yeah.
business?
No, it cannot. That's where I was coming to.
All
Example,
right.
Sam. Okay. Now the safest asset. Okay, so this is the first one. Price and interest rates are inversely proportional. Any questions
Mm-hmm.
on this?
No.
Cool. Now this is your safest or the risk-free interest rate. It is the 10-year treasury of the US. I mean, treasury is government. So 10-year treasury from the US government is the risk-free asset. So every asset price, remember, right? Inverse interest rate and price are related. Now, the safest asset controls the rate and price, and it's the US government 10-year treasury that controls everything. So, this chart shows the interest rate from, say, 1980s or a little before, all the way till today. What do you see from this?
I mean, after like I don't know, 83 starts to decrease steadily.
Yeah, steadily. Do you know what's the current interest rate?
1.4448.
Yeah, and
Is that
that's,
percent?
yeah, it's a percent, 1.4%. Now, what happens when interest rate decreases? What happens to the price of the asset?
Um, if the if it decreases, I mean the price also. Oh, since it's inverse, the price would increase,
Price
right?
of the asset increases, right? Now let's do a quick check, and which is the last tab that I had here. So I took a snapshot of 2007. Remember the asset that I showed of US households?
Yeah.
2007, 2021, and I've taken a peak. 2007 is a peak where the crash did not happen. Even if you look at the peak, look at how much the value of corporate equities, I mean, the overall value over here has gone up by.
8.2%.
Yeah. So what happened, and what's the inflation rate during this period?
Um,
Maybe 2%. Right?
yeah.
The economy definitely did not grow at that rate. So the point I'm trying to say is as the rates go down, which is this, asset prices go up, and it's the safest guy that dictates the terms in the market. And the safest guy in the US is your US Treasury, because a government cannot go bankrupt. They can print money, right? I mean, they can do
Yeah.
anything that they want to. Okay.
Mm-hmm.
And the last thing before we conclude for today, and I'll share one more point after this, is a bird in hand is worth two in the bush. What it says is, say, let's take, say, your friend comes to you and he owes you $100. He says, Vibhu, I don't have $100 today, but I will give you $100 2 years from now. Is the
Yeah.
$100 today same as the $100 2 years from now?
No,
Why?
because due to inflation, the $100 2 years from now will be worth less.
Exactly. And you could invest that $100 today into something that could in fact grow faster than inflation, correct?
Right.
So money, this is called as, this concept is called as time value of money, where a money today is not equal to the same amount of money in the future. So this is another concept that you have to think about. So what I'll do, okay, this is the last piece. Do you know what's the best investment one can make?
Um,
Which we so looked at so many assets like gold,
a,
stock, bond.
a
I mean, we will
stock maybe or index.
stock or an index. Okay, so we will talk about that in the next session, but not for now. I think, not I think, I believe that the best investment one can make is to invest in yourself.
Oh wait, that was on the graph.
Which one? Yeah,
I
yeah.
was thinking of stuff from the graph.
Hey,
All
no, no, no.
right,
I just that's a trick question.
all
So
right.
how do you excel? How do you get better at what you're doing compared to where you were in the past? You're not going to compare with anybody. That's not the game that anyone should play. It's like, hey, am I getting better? Am I improving? Remember the compounding on lesson one. So it's a game of it's a lifelong journey inwards. And how do you get better and excel at things that you are passionate about or that you want to excel at? So what I'll do is I'm going to stop here, Vibu, and
Mhm.
next week, next one, not next week, the next session is going to be on equities. The reason why I chose equities is we saw close to 55% of the US households own equities, and most of it is in stocks. So that would be the best place to start, and we will spend a lot of time there. So one book I would recommend before we conclude is the Little Book of Common Sense Investing, and this would kind of give a broad brushstroke of what we covered today, and it would set you up for what we are going to talk about in the next session. Any
All
questions?
right. No.
Okay, we are done. Thank you.
All right. Thank you.